So this TGIF, my name is Break Even Trader. So guy, I'm just a bullshit artist over here. So this ICT's concept. So this is a weekly retracement that's 20 to 30%. 20 to 30% of a weekly range. It actually occurs once a specific PD array has been traded into, or a weekly objective has been met. Let's just say a weekly objective has been met. That is, if the market has traded into a specific PD array, or into a specific PD array, and it can trade through a liquidity into that specific PD array. Name them: fair value gap, order blow, all those PD arrays. You can name them. The list is too long. So for this case here, we had our weekly objective for this day. It was let me show you for a second. See this black line above there. Let me show you for a second. See the black line there, 1993.25. 1993.25 is a buy side liquidity. See, no, not really. It's here. See this point here? I'll show you for a second. We have this high here. So this high here, 1986.85, that was our buy side liquidity. Buy side liquidity, it means there are people in this market, young boy, there are people in this market who are selling, and they have their stop losses resting at 1986.85. So we have to take their stop losses, and once we take their stop losses, that's bringing liquidity into the market. Yani, liquidity is money. We bring that liquidity into the market. You understand me? Say it loud. You understand me? You understand me?
Yes.
Exactly. So once we trade through a liquidity, we don't just trade through a liquidity and just retrace. We can trade through a liquidity into a certain PD array. That is a fair value gap or an order blow. All those PD arrays, there are many. I'll teach you one by one. You understand me? So for this case here, we had a fair value gap in form of a CB. So we had to trade through that liquidity into that fair value gap. You understand me?
Yeah.
So at that point, we traded. Let me show you. We traded 20. Let me remove this for a second here. Let me remove this from my daily chart for a second. Okay, so for this case here, we traded 25% of that fair value gap. We actually divide. You see, a fair value gap is divided into 4 parts, 4 quadrants. You understand me? That's into quadrants. That's the lower, the half point, the upper quadrant, and the into 4. You understand me? So we traded into the 25%. So at that point, I was weighing that. What is the time at that point? Let me go back to 1 hour and show you. We are in 1 hour. See this? The point, let me remove this fib for a second so that you can actually see what I'm trying to tell you. Done. Oh, not really. So see here, you see this candlestick here with the 3 dots right above it. That one has already met our weekly objective. At that point, it was at 16. Let me show you for a second. It was at 16. That's 18. That's 6 p.m. Kenyan time. That's Nairobi time. And in New York at that point is 11 p.m. 11. That's the end of a silver bullet. Same at the end of a silver bullet. So at that point, I was weighing on time. Now we have to retrace. Where are we retracing? To a random place? No, 20 to 30%. Where are we retracing to? 20 to 30%. So at that point, let me bring in my fib for a second. Let me bring in my fib here. See that 0 mark? That's our high of the week. Our high of the week was formed at 1800 Kenyan time, which is 11 a.m. That's 6 p.m. Kenyan time, which is 11 a.m. New York time. That's morning in New York. We are heading into a New York lunch. You understand me? So at this point here, we had to retrace. Where are we retracing to? 20 to 30%. 20 to 30? We can retrace anywhere. We can retrace to 20, 21, 22 and stop there. But what is going to show us how the distance, what is going to show us how far the retracement is going, how big the retracement is going to be is time. So we are monitoring on time. The market is supposed to close in Kenyan time. That's 23:59. That's 11:59 p.m. That's midnight. 1 minute to midnight. So in this point here, let me drop down. See the retracement here. See this blue line here, 1975.06. That's 25%. 30% is below here. Let me drop down for move this. That's useless. Let me show you here. We have it here, guy. Young boy. So let me zoom in. See this 1800, it's right at the top there. See that point there, we have a fair value gap. Once we start the retracement below, actually let me show you something here. There. Do you see this candle here? That is a point, a swing point, eh? And also, do you see, let me show you. Do you see this? We have shown the willingness to trade low. So at this point here, instead of buying a turtle soup or selling a turtle soup, wait for the breakdown. A fair value gap is formed. See that fair value gap? Very nice. We're trading back into it. And now you know that we have to retrace 20 to 30%. It can be 26, can be 27, depending on time. You understand me? So you are weighing on time. Your take profit is supposed to be based on time. You understand me? So once we are in there, I've entered into a trade. Sell. I'm in a sell program. I'm riding the market with smart money. Smart money are the big people, the banks, they name them, all those people who have big monies in these markets. So see this retracement, how fine it was in there. See how it's retracing here. See this. Once you see this move, the bigger move like this, if you miss that entry up there because you fear stuff, nini, I understand there is a lot of fear in this market. See this point here? You see that point? Also, see this point here. Which one is low? The second one, right? Once this happens, you wait for a fair value gap to form in between this leg from up here to down here. But remember, there will be a fair value gap that is going to be remaining unfilled. And that fair value gap is going to be formed close to a swing point. See, we have a swing point here. Let me show you. We have a swing point. See this? A swing high. Let me show you. Let me show you from this side. See this point here? This is a swing high. The point where it's curving. Let me show you. Go. At this point here, we have a swing high. Below. At that point. So you see this fair value gap here is not important. it's going to remain unfilled because it's close to a swing point and the market has shown willingness to trade low. You understand me? So at that point, you enter a fair value gap that is closer to this. Let me show you. You enter, you see this, a fair value gap that is closer to this point. Where is that fair value gap? This here. If you drop down, you see between this candle, let's drop down to 1 minute so that you can see that. Let me drop you to 1 minute. Let's drop to 1 minute so that you can see that. Young boy, I want you to trade these markets just like me. Is that okay? Is that okay? Huh?